Much has been written, and much more will be written about Silicon Valley Bank and its rapid demise over the past several weeks, for perhaps the next several months, or maybe even years to come. In all that I've read so far, I really have three reactions as it relates to enterprise risk management that really have very little to do with banking. One is the chief risk officer, two is the risk committee of the board, and the third is arrogance. So let me explain. The chief risk officer, number one. It was a position that was not held in high regard at Silicon Valley Bank. It was a position that was held vacant for 8 months during a very critical time, not only for that bank, but in financial services for the past 15 years, or maybe even arguably over the past 40 years, as the Federal Reserve Bank made it very clear that it was going to raise interest rates in order to be able to tame inflation. Had that position been empowered, perhaps the situation at Silicon Valley Bank would be very different today. The second is the risk committee of the board. There's a couple interesting things there. Apparently the risk committee of the board had met 18 times within the past year. That's more times than they had met cumulatively in the previous 3 years. The risk committee of that board was comprised of the chairs of other committees of the board. In addition, it was comprised of two members who I would consider to be heavyweights. One was a former vice chair of the U.S. Treasury, and the other was a former vice chair of a large international accounting and consulting firm. These were clearly bright people, but they clearly failed their role. They failed their charter, they failed their shareholders, and they failed the depositors of the bank. I think what's interesting too is that each of the members of the risk committee received fees in excess of $250,000 in 2022, and were slated to earn over $300,000 of fees in 2023. That number seems awfully generous at this point, just given the outcome. But statistics like these really give rise to this concept of stakeholder capitalism and add more fire to the thinking behind that. So we'll have to see what develops there. The third is the arrogance of the CEO, the arrogance of the senior leadership team, in their disregard to effectively manage their situation as it related to interest rate risk. It was very clear, again, that the Federal Reserve was keen on raising interest rates. And so their disregard for that risk management is something that has to be evaluated. The risk committee of the board can never be distracted by the charm or perhaps the force of the CEO, and certainly the fees involved in their role. Perhaps the punchline about Silicon Valley Bank is that it had a dysfunctional culture. Every successful ERM program has to begin with culture, where everyone within the organization, from top to bottom, understands their role and the fact that they have a responsibility related to enterprise risk management. For more information about enterprise risk management, check out ermexchange.com.